Hello, this is Phil Ash, president of Investing Daily. I am, for the most part, a buy and hold investor using stock recommendations from some of our services, such as personal finance and high yield investing, among others. But I do like to play around with options. And while today is not the typical options expiration date, the third Friday of each month, I do have several options expiring today, June 2nd, the first Friday of the month, and it is noon Eastern time right now. So let's just take a look at a few of those options over in my TastyTrade account here. I will just sort this by days till expiration, and you'll see that I have two options spreads expiring today. These are from Jim Fink's Options for Income service. They are, for the most part, all put credit spreads, which this video will not go into how those work, but I will put down in the comments section a link to some other videos that can tell you more about put credit spreads and how to get into what Jim Fink calls the greatest investment strategy on planet Earth, and I do not disagree. I traded Jim Fink's Options for Income full portfolio several years ago successfully for about a 25 to 30% annual return, and then just got busy with some other things and got out of the habit. I have recently reactivated this account as of the end of February 2023. I seeded it with about $5,000 initially and then gradually added more money. It's up to $20,000 now. I'll probably need to put about $25,000 in here, which is what we recommend to be able to trade one contract on every one of Jim's recommendations. You can certainly trade just with $5,000 if you want. You just wouldn't be able to do all of his trade recommendations. And of course, you can put more money in if you want to trade more than one contract per trade. Anyway, looking at these two trades I have expiring today, I sold a $225 put option and I bought a $220 put option simultaneously to create a $5 put credit spread each on one contract. That means each contract is worth 100 shares of stock, so that means I put $500 at risk here. However, let's just look at my transactions here. When I bought this Visa trade, I collected a credit of $450 and I bought insurance in the form of a put option at $300. So I collected a net of $150. I will be able to keep that $150 regardless of how this trade turns out. And because this is a $5 spread, meaning I put $500 at risk, but I collected $150 that I get to keep regardless, 500 minus 150 is $350 that I really had at risk. So $150 gain divided by $350 at risk means that this trade, if it works out successfully, will be a 43% return in just a matter of a few months. So, is this trade going to work out successfully? Well, it expires at the end of today, and all I need is for the stock price to be above 225, which it is by a good margin. So again, it's around noon today. I have 4 more hours to find out if this trade will be a winner, and I expect it will be. My other trade expiring today, TTWO, similarly is a $5 spread, and I just need the stock price to finish above 119. It is significantly higher than that has been for weeks, so this trade also will turn out to be a winner. On this particular trade, I collected a $167 credit. Therefore, 500 minus 167 is $333 that I really had at risk. So 167 divided by 333 is a 50% return that I will get on this trade, again, in just a matter of months. So that is what's going on in the world of Jim Fink's Options for Income on this Friday. I will put down in the comments section a link to some videos if you'd like to learn more about how trading put credit spreads works. And if you have any questions, feel free to drop me a comment. I hope this was helpful. Have a great day.